Hey everyone, welcome back to Corporate Decoder, the place where we decode the documents that companies don't want you to read. Today we're going through a shareholder report, but it's not just boring numbers. We're talking about investment strategies, potential risks, and where your money might be going, all explained in nice, simple language. You might even start thinking you know more than your broker, just kidding. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you subscribe. We also have a Discord community linked in the description below. This report is from the Columbia Short Duration Municipal Bond Fund, and it covers the period from May of 2024 to April of 2025. Basically, it's a report card showing how well this fund performed and what it's been up to with its investments. First up, let's talk about costs. If you had a hypothetical investment of $10,000 in Class A shares, the cost would be 65 of 64%. Knowing this helps you see how much of your returns are eaten up by fees before you even get started. Note there are multiple share types with differing costs and returns. Now let's check who helped the fund perform well this year. That includes careful credit quality selections, meaning picking bonds from companies that have high likelihood of paying back the bond at single A rating, or higher sector allocation overweights to industrial revenue bonds were positive contributors to the fund's performance relative to its benchmark. This means a portion of investments into industries that did relatively well made the fund look good. Good security selection in education, utilities, special tax, local general obligation, and airport bonds also help boost the fund's overall performance. This translates to investments into everyday things, and airport bonds also helped boost the fund's overall performance. This translates to investments into everyday things. But it wasn't all sunshine and roses. Bad yield curve positioning or overweight to longer maturity bonds detracted from performance relative to its benchmark. As municipal market interest rates rose in this portion of the curve, the manager overestimated how long the bonds would take to pay back. Security selection in CCRC, IDR-PCR, and housing bonds were more modest detractors. Finally, an underweight to pre-gas bonds was a modest detractor, so investors were not exposed to the benefits of natural gas. Time to look at the actual numbers. Let's imagine you invested $10,000 in Class A shares. Class A shares had a 3.05% return that after including sales charges, it drops to 2.03%. The Bloomberg Bond Index showed 3.28%. It is important to note that there are a few disclaimers here that need to be addressed. The fund's performance prior to September 1, 2022 reflects returns achieved according to different principal investment strategies, basically stating that returns might be different if they use their new strategy the whole time. In August of 2024, the fund switched benchmarks for regulatory reasons to the Bloomberg Municipal Bond Index, so the fund compares its performance to both Bloomberg Municipal Bond Index. And its prior benchmark to properly represent the assets of the firm. Here also is something interesting. We get to see where the fund is invested. Most of the investments were in New York or Texas. This means that is New York or Texas go down, so does your money. There were a few changes that the fund has made that are important to highlight. In August of 2024, the fund changed its strategies to include the tender option bond TOB transactions, with things like floating rate municipal securities, futures, bond futures to hedge again changes in those futures, and swaps to do the same. Let's talk about fees paid to the accountants. For the year, the fund paid $42,744 related to auditing reports and $13,795 for tax compliance. In other words, you want to make sure you do things the correct way, so you have to pay other people to look over you to ensure you are compliant. Also, there were non-audit fees paid to the tune of $47 for services rendered to, and under common control of the advisor. Also, the form dives into the need for their audit committee to pre-approve services to the fund. This means there are watchdogs to make recommendations to be followed by the committee to protect shareholder rights. Alright, let's deep into some of the actual financials of the investments themselves. A high percentage of the firm's investments are in floating rate notes. These are basically debts that are paying the firm's dividends at varying rates depending on the climate. Next, we have the municipal bonds that also comprise the majority of the investments with an 89.6%. Municipal short-term bonds comprise 8.1% and money market funds comprise 1%. Alright, based on the financials, it seems like all the assets have an approximate value around $293,648,800 at $196,724,433 means that they are not doing so well. Overall, the net asset value applicable for shares is 294,298,942. Net income for the business due to operations is 10,253,509 tono. Overall, based on this data, the fund isn't doing great, but maybe a tick above fine. The performance is just above what the expenses are costing, and overall is barely eking out a gain. So let's take a look at some of the risks that they are accounting for. One big risk is credit, basically. Will they be able to pay back debts, and do they generally default on their debts? This is a measure of how confident a lender or investor is that payments will be made, and in a good or bad economy, bonds may not get paid back as often. Next is interest rate risk. Will the investments tend to fall? And if interest rates fall, the values of debt instruments tend to rise. Also, interest rates affect the economy overall. There is always the risk of liquidity. Liquidity is just if you are able to convert your assets quickly to cash. There may be things that hinder the ability to do that quickly. On top of all of that, there is market risk, natural disaster, terrorist attacks, or even just a bad feeling about a company may trigger some volatility and the assets might not be worth as much. Finally, there is shareholder concentration risk. At April 30, 2025, one unaffiliated shareholder of record owned 41.7% of the do affects the fund and one or more accounts. This means that what they do affects the fund. The fund is okay for now. They are making all the proper disclosures and ensuring everything is on the up and up internally, while also keeping the risk factors in mind. Now, to conclude from Warren Buffett style analysis, it's doing okay for now. The changes they made seem reasonable, but again, the overall world climate adds concerns to their investments. Alright, that's our breakdown of Colombia's short duration municipal bond fund. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribing helps us come up with more content. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.